Hey everyone, welcome back to the channel. This is LC. On 10 October 2020, I watched a live stream that's organized by CIMB where Dongguan Executive Director Alvin Ang introduces Dongguan products, business performance, growth drivers and expansion plans. I strongly encourage you to watch the video to have better understanding about Dongguan. You can find the video link in the video description below. Alvin Ang's speech has raised my interest to study Dongguan in more details. Here, I will provide insights about Dongguan from different perspectives. Make sure click the like button, subscribe for more, and ring the bell. This video takes me lots of efforts to create. I won't show you those long disclaimers which you never read. Do your homework and formulate your own opinion. Let's start with quick summary of Dongguan performance. As a result of continued sales growth and higher profit margin for its plastic products, as well as sales increase in its tea and coffee products, overall revenue rose by 9% year-over-year. Gross profit margin rose from 12.4% to 14.4%. EBITDA margin rose from 6.1% to 8% due to increased sales of products, lower cost of raw material, and lower net interest expense. With lower tax rate but higher non-controlling interest deduction rate, FY19 net profit rose by 41.6% year-over-year due to dilutive impacts of conversion of ICULS and exercise of warrants. FY19 diluted earnings per share was lower at 37.27 cents. Revenue of Dongguan has been increasing 5.73% in compound annual growth rate from 711 million in 2015 to 939 million in 2019. According to Alvin Ang, Dongguan expects double-digit growth in 2020. I have slightly different opinion. The trailing 12 months revenue is 960 million, which is just 2.2% growth from 2019 revenue. In my opinion, it is very unlikely Dongguan will achieve double-digit growth rate for its revenue. On the other hand, refer to net profit. Dongguan has high chances to achieve double-digit growth rate if compared to first 6 months cumulative net profits in 2019, which is 26 million. Dongguan already gained 38 million in 2020, which is 42% growth rate. However, I prefer net profit growth is driven by revenue, not lower raw material costs. In terms of operating profit margin, we usually use EBITDA margin for manufacturing companies. We incorporate depreciation in calculating operating profit margin because we want to measure companies' capability to reinvest in property, plant and equipment to maintain their competitiveness. Dongguan recorded 8% EBITDA margin in 2019 and 9.5% in the last 12 months. One of the main contributors to improving EBITDA margin is lower cost of raw materials. The main raw materials are polyethylene and polypropylene and other petrochemical products. The dirty secret behind these raw materials is that they are derived from fossil fuels. A picture is worth 1,000 words. Check out the crude oil prices. If you haven't heard, there's been a shale revolution going on and the world is awash in natural gas. The results are reverberating throughout the entire plastic production chain. Ethylene is now cheaper to make due to cheaper energy costs, cheaper feedstock, and the past few years have seen a significant expansion in production of both ethylene and polyethylene. Besides, take a look of prices of polyethylene and polypropylene. The prices of both are cheaper than previous years, but bouncing up. So we need to consider rise in feedstock prices. According to Dongguan, there is a pass-through mechanism in the case of a price increase. Due to the Japanese business culture, there is some time lag for price changes for products exported to Japan. However, the silver lining in this is whenever raw materials prices drop, the products exported there get wider margins. On one hand, this mechanism reduces the risk of higher costs can be passed on to customers if there is a rise in feedstock prices. On the other hand, this mechanism may not be applicable to other countries. Rise in feedstock prices is a risk we have to keep in mind. Compared to other plastic companies, as shown in this chart, EBITDA margin of Dongguan is relatively lower. This is because Dongguan reinvested their profits in new plantations to expand their production lines. Next, we use return on invested capital to measure how efficiently Dongguan is using its capital and whether or not its competitive positioning allows it to generate solid returns from that capital. Dongguan's ROIC is ranged from 6.3% to 7.8%. Dongguan has been increasing their invested capital by two ways. First, raising debts, where total debt of Dongguan increased from 51 million in year 2015 to 143 million in year 2019. Second, raising capital by using ICULS and warrants. Dongguan reinvested its investor capital and profit in expanding production lines, subsequently generate stronger revenue. Compared to its peer, Dongguan ROIC is actually not bad. Despite increasing debts, looking at its leverage and coverage, I'm not worried about it. Fluctuation of the free cash flow is quite huge due to increasing capex. This aligns with what we observe EBITDA margin. Dongguan's cash position is very strong. Valuation wise, I estimate 40 cents earning per share for year 2020. Higher growth rate for year 2021 to 2024. I factor in 22.5 million units of ESOS offered by Dongguan, which effective from 3rd July 2019 to 2nd July 2024. Earning yield of Dongguan range from 7% to 13% in average in the past 5 years. As for DPS, I assume 24% dividend payout from 2020 to 2024. So I estimate its DPS will range from 9.4 cents to 11.7 cents in the next 5 years. Dividend yield of Dongguan range from 2.7% to 3.7% in average in the past 5 years. Pretty low actually. I won't invest Dongguan for its dividend due to its low dividend payout and low dividend yield. I will target capital gain. I try to apply discounted cash flow here, but I won't include valuation derived by discounted cash flow. I won't go through the process here. In short, percentage of implied enterprise value from terminal value and terminal free cash flow growth rates are too high. This is complex topics I won't cover here. The next step after valuation is to estimate fair value. I will use earning yield to estimate fair value, not dividend yield and discounted cash flow. Based on the baseline scenario, The fair value range from 5.66 to 6.74. The fair value uncertainty is low. Now we have to determine the chances Dongguan to hit 6.74. The current earning yield of Dongguan is around 7.1%. Based on peer comparison, 5-year average earning yield of this industry is around 5.17% earning yield. If we apply 5.17% to Dongguan, the fair value range from 7.81 to 9.29. Look at the earning yield chart again. Dongguan did reach 5% plus earning yield in the past, but for 5 to 6 months only. So I think 6.7 to 7.8 seem like a reasonable range of fair value for Dongguan based on 5 years perspective. On 16 October, Dongguan bonus issue of up to 191 million new ordinary shares, which is equivalent to split 2-to-1. After the split, the range of fair value for Dongguan is from 3.3 to 3.9 based on 5-year perspective. As at 16 October, Dongguan's close price was 2.87. I may be wrong in my opinion. At 2.87, the upside is less attractive. I will wait for a retracement to start invest in Dongguan, maybe around 2 to 2.3. Business outlook wise, Dongguan targets to export to more markets and concentrates on continued expansion into higher margin production lines to sustain the plastic segment's margins going forward. Outlook of the plastic packaging is quite promising. I share a couple of articles in the video description for your bedtime reading. Please leave comment below if you have different opinion or I miss out something crucial. You can download my working files by checking the links in the video description. If you enjoyed the video, give me a like and share it out. If you didn't, a dislike. Subscribe for more, ring the bell, and I will see you in the next one.